Will interest rates ever drop to 3% again? No, not anytime soon. That was a manipulated monetary policy that happened as a result of a freaking global pandemic. So let's dive into where the rates are going today and what you can do about it.
How to Buy a Home educates, protects, and connects first-time homebuyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time homebuyers.
What is up, my How to Buy a Homies? I'm your host, David Sidoni, and I'm going to be starting today with the most devastating truth bomb that I think I've probably ever dropped here on the show. Now, for some of you, this is going to be a brutal reality check. So hang on to something because it's about to get real. Right now, in 2025, if you're a renting Gen Z or a millennial looking to buy a home, you got hosed when it comes to home buying, period. And I know that many of you out there are feeling that way. And you're looking at the current affordability crisis of 2025, and you're desperately hoping for some sort of crash or a correction, something that's going to level the playing field. Specifically, I know a lot of you are waiting for lower mortgage interest rates. But the flaw in that is that you're watching and waiting through the lens of an inaccurate recency bias. And it's not a big surprise since, your idea that you've had about owning a home, it's only recently popped into your head. And this is the part that sucks. When you look through that recency bias, that means you've seen 3%, 4%, 5% interest rates. They were around the last 4 years. So you assume that's a normal cycle, a normal occurrence, and you're waiting around for them to come back and be your salvation. Well, I'm here to drop the painful truth because I want you to succeed, and there is a way. And sometimes to get to where you want to go, you need to really accept the truth and the math of what's happening. So 3, 4, and maybe even 5% interest rates, they are not coming back. They were an anomaly, an abnormality, a glitch, the result of that artificially manipulated market to correct a once-in-a-century global health crisis. And they likely aren't going to happen again in your lifetime, let alone in the time that you're going to be trying to buy a home. But we've got answers here today. We're going to give you a more realistic expectation on mortgage rates and help you find the right rent replacement strategy to work within the reality that we have, what you should be expecting in the next few years. And I'm going to break it down to you, starting with the history of interest rates. Since 1970, the average mortgage interest rate has been 7.7%. That is the norm, average. In the last 25 years, the Fed has faced 2 gigantic, epic financial meltdowns. And what we saw were reactions in unprecedented fashion. And it created these once-in-a-lifetime super low rates that a lot of people think are part of the normal cycle, but they're not. In episode 237, I went even further back, all the way to the 1940s, to show you how our government has reacted. And these 2, in the last 25 years, those are the biggies. So it's not a cycle, it was a reaction. Here's those 2 giant events, what happened, and the results. In 2008, went all the way to 2012, the United States suffered the Great Recession. And that created a full global economic meltdown. So the interest rate intervention and manipulation began because in 2008, interest rates were at 6.03%. By the time we got to 2012, due to the Fed stepping in, they had dropped to 3.66%. The average over those 5 years was 4.78%. That means it took the worst 5 years in economic history since the Great Depression, and including a real estate meltdown to move interest rates to that average of 4.78%. And the second one, unbelievably, we suffered another one. I mean, we're talking 2 global financial crises in less than 15 years within all of our lifetimes. That's nuts. So the Fed intervened again. And this one was more recent. And so maybe you've got friends who bought their homes, from 2020 to 2022, and they're sitting there with a 3 or 4% interest rate. And if you don't have friends, then I'm sure you've heard about that. This was a ridiculous once-in-a-lifetime opportunity, a post-pandemic artificial manipulation. It actually led to the lowest rates we've ever had in history in January 2021, when rates were at 2.65, like the lowest ever recorded. So that's just the facts behind things. I know with that recency bias, a lot of people think it's a normal cycle or swing in the market. It's not. And the reality is, if you're waiting for that cycle, looking for rates below 5% again, that means you're asking for something nutso to happen again. You're looking for the worst global financial crisis in history to happen one more time, or you think, hey, maybe the bubonic plague will get me the interest rate so that I can buy a home. So here you are looking for the data, trying to figure out what to do moving forward. Well, have no fear. I am your major real estate nerd. In fact, on this very podcast back in January 2021, I told everybody that was listening that 2.65% interest rate, that thing was historic, like no joke, literally once in a lifetime opportunity. Now, the homies who listened back then, and they ignored the public fear. They followed the facts that we laid out right here on this podcast, and they built a solid personal plan, taking advantage during what a lot of people saw as a very scary time to think about real estate. And today, those people, they're not only sitting on a ludicrously low interest rate, they also have gained, on average, 42.1% in appreciation in their home equity. And if you're scared about rates, I get it, but let me tell you a little truth about real estate that the average person isn't aware about. All buyers and sellers, they suffer from recency bias in every single market. Every single one. Doesn't matter what's going on. Super buyers market, super sellers market. Everyone's just looking at what recently happened. Buyers and sellers always find something to fear. And that means they're missing opportunities because they're not looking at the full, clear picture. They focus on the small window of time they're familiar with instead of looking at the historical data, which is going to help them create the best long-term strategy, which then, of course, is going to reduce their fear. But instead, they get wrapped up in the anxiety of the now, and they let that dictate their decision-making process. I've been doing this for almost 20 years, and I have seen this thousands of times. So here it is. Here's what's happening with interest rates. Barring a once-in-100 years event, your decision on the interest rate that you get for your home purchase should be predicated on the long historical data, 7.7% over the last 50 years. And I understand 2025 is a tough market. There are high prices that go along with those high interest rates. But expecting the rates to hang where they are for a while, that's going to be your best play, not waiting for the dream rates that existed in those extraordinary times and those economic meltdowns. And there are solutions, and we're seeing people work through the fear and make it happen. So you can forget the fear and instead accept that the reality of what's happening right now and focus on the facts. I'm going to reveal the how of buying with a rate even near 7%. Because that's going to secure two things for you. In the event of a recession, you're going to have the stability of knowing that you have control over your life. No landlord can sell out from underneath you in a recession if they need to make a desperate move or raise your rent so that they can stay afloat. And then secondly, home ownership, that and the protection of a forced savings account in the form of the asset that you are sitting on, that is a giant hedge against inflation. It's about security, stability, and control. And more importantly, when you own a home, even at a 7% interest rate, you have a colossal advantage. Everyone else is sitting with fear and worry and recency bias. So they're sitting on the sidelines, not going to buy a home this year. The numbers are there. Surveys show like 80% of buyers are waiting for rates to drop. So what does that mean? When rates drop in the near future, those bidding wars will get hectic. And then the real winners, they're going to be the homeowners who bought in early 2025 at a 7% interest rate because they've locked into a lower price on their homes. And while they see their value of their home increase, if rates do drop to a very low level, the bidding wars happen, but you're sitting there, low-priced home, and now you can refinance into that lower rate. So my truth bomb, yeah, it's harsh. I don't offer the salvation of a prediction for a 4 or 5% mortgage rate coming. And damn, I really wish I could offer that. I mean, yes, I would love that for all of you. I mean, that's why I spend so much time here. I'm trying to make it as easy as I can for first-time home buyers because it's rough all over. And now we've got this new thing to work around. So that's what we're going to do. Right now, people are dying to hear someone tell them, oh no, hang out, rates are going to drop. And if I could say that with any conviction, that'd be awesome. I mean, it would grow my local real estate business as well as the national audience. I mean, people would eat that up, but that's not what I'm doing here. I'm playing the long game, offering just the truth and the reality, because that is where you could find the solutions in the current real estate market, no matter what the market's doing. I'm not going to play the clickbait game, even if the truth sometimes sucks to hear. And right now it's not great, but we've got answers. Okay, I'm going to give you a quick data dump so that you can confidently know what's happening right now with interest rates. And then I promise I'm going to get you to the solutions, the strategies that are winning, and what we have seen work with buyers nationwide, complete with all the steps and the mathematical data to back it up. Millions of first-time homebuyers over the last 25 years didn't get a 3, 4, or 5% interest rate. And you know what? They're still winning. They found their own rent replacement strategy with rates at 6, 7, even 8%, because their homes have increased in value. Not to mention, there was a killer dip to 6.1 October of last year, so a lot of them refinanced down into the 5% range. And if you're confused about that, let me explain. 6.1 is the national averages. Averages can be beaten. More on that later. So here's where we're at in a current stalled housing market, which is primed for confident, informed, and non-fearful buyers to actually take advantage of playing the housing market in the traditional fashion. I did drop all the detailed data on rates, where they are today and where they're going, in the mid-year forecast and predictions podcast a week ago. That was episode 361. What we've got going on is that nationally inventory is rising. The price increases are slowing and perhaps even flattening in some areas. However, that's the national information. On the starter homes, we're actually seeing reports and hearing reports from the unicorns and first-time homebuyers all across the nation that they're still in multiple offer situations for starter homes, which is driving up the prices of the homes that you want to buy. So that means you've got two choices. You can wait for the economic collapse to bring you affordability, assuming that you survive that crash, or you can start your plan today. And now notice, I didn't say, or you can buy a home today, or buy a home ASAP. I said, start your plan. And that way, you can be prepared to act on your own timeline. And I understand why you haven't started. I understand why for so many of you, the answer is to do nothing. Just waiting for things to get better before you think you should get started. We are smack dab in the middle of another fear cycle. So remember what Warren Buffett, one of the richest men in the world, and largely considered one of the greatest financial analysts in several generations, he said this: when others get greedy, be fearful. And when others are fearful, that's a time to be greedy. And I get it. That's from him. You're an aspiring first-time home buyer, not some Wall Street investor dude. So what is your play in a stalled housing market when the public is being fearful? Well, you get educated, you plan today with confidence, and you look for options and advantages that others are too afraid to consider. Let's get into the strategies on how to win even with a 7% interest rate. First, this is very important to know. The rate isn't the rate. I know that's confusing, so I don't know. The words of Inigo Montoya. Let me explain. No, that is too much. Let me sum up. When I quote the average interest rate like this, on July 1st, the average 30-year fixed mortgage interest rate was 6.67%. That is the average. Averages can be beaten. That means well-prepared and organized buyers are getting rates, 6.1, 6.2, I've been hearing, and sometimes even lower. So there's your first tip on how to beat high rates. Don't do it on your own. Don't assume that the average rate that's quoted out there or that you find on the internet is the lowest rate that you can get. You absolutely cannot find your lowest rate in just a few clicks. I know the tech is good out there. Don't get me wrong. I think it's great and very helpful. But all that's going to get you is the lowest rate that an algorithm can get you. So please hear me, homies. If you want to save tens, maybe even hundreds of thousands of dollars in your home purchase, put some time in with a professional guide who has the experience and the knowledge that it takes to discover all of the best options specifically for a first-time home buyer. I get it. You can scan a website for the lowest rate available. You can even do a quick application with an online lender. those results are going to be the very minimum lowest rate that you could get. Or worse, they're a bait and switch interest rate with tons of hidden fees and costs that pop up later. It costs you nothing to get a real accurate quote based on your own personal data, all of it. And then you've got a pro to help steer you in the right direction, to help you find the ultra creative custom loan programs that serve you best. Don't settle for the cookie cutter algorithm answers based on just a few pieces of data. Do a little research. Vet and qualify real estate support teams, or just ask me if there's a local unicorn in your area and you can check it out. No obligation, no cost to you. I can't say this next bit with more emphasis, more passion, more just straight up truthiness. When it comes to rates, enthusiastic, researching first-time homebuyers are doing it all wrong. Period. The end. Curtain. And I'm not blaming them. It's not their fault. The internet is blanketed with all the wrong information. I mean, you're told by 98% of the internet to shop the hell out of an interest rate. You'd be an idiot not to do it. And hey, don't bother a realtor until you do this first. Find out how much home you can buy. Here's the insider secret on why this is the information blanket that you find when you do your researching that sends you down that rabbit hole. Realtors are local. That means when someone's looking online, they cannot help 99.9% of the people that are on that website. If you're looking at a national informational, educational site to talk to you about interest rates or real estate, realtors aren't there. I mean, they only work in a local area. But lenders, the people who loan money and want you to be their customer, they can be licensed in all 50 states. So they are the ones blanketing the internet to capture you. Capture, that's their word that they actually use, and then sell you a product. And they know you're looking at interest rates. And that, homies, is one of the big reasons why I started this revolution. This is why I started the podcast, to pull back the curtain and show you a better way. And right now, man, the movement, buyers getting empowered, it is growing in full force. Education is winning. So be smart, be prepared. Don't get captured. Now, your tip, that's spend 20 times the hours researching and vetting a realtor more than you spend researching how to get the best interest rate. I hope you're really digesting that. And notice, I said researching, vetting a realtor, not a lender. This is going to sound crazy, but that's what we've been doing here, and that's what's been working for thousands of people all across the country. The formula to get a best rate is finding the unicorns, starting with a unicorn realtor, because they're going to have multiple local lenders that care about you and your end result. And you can talk to all of them. Find the one that works best for you. Find the one that is going to bend over backwards and twist into a pretzel to help educate you, to help guide you, and to help you build your ultimate best plan. It's so much different than just someone on a website who is there to capture you and sell you. Plus, you get the advantage of going through the realtor first, getting the lender, and now you have a cohesive team. It's an advocacy partnership, fiercely dedicated to you and your best option. I realize that nowadays you can get an instant quote, on everything. There are websites purposely designed to make it seem like they can give you an accurate rate assessment in just a few clicks. There's even slider bars on some of the apps that you can do it right there on your phone. This is a big effing purchase. This is gigantic. So find the team. The real estate support team will not only help you with the education of the process, they're also going to help you unlock options on mortgages. The stuff that the national capture corporations, they're not even going to mention to you. So if you want the best rates, focus on that tip. Researching rates on your own, it's just inaccurate, incomplete, and not something you should rely on when you're making the biggest financial decision of your life. Now, I'm going to share a bunch of practical action steps to help you navigate a purchase in a high interest rate market. But that first step of finding the right lender who can give you other options besides even the things I'm going to give you right now, that's the big one. Okay, here's action step 1, understanding how much home you can afford right now with the best interest rate you can get. How much home you can afford is the very first variable in your personal equation. And so many people ask me all the time, wait a minute, I make this much a year. How much home can I buy? I've been answering this question, all the way back since I started in 2019, some of the earliest episodes. The most recent episodes that have the best information, that's episodes 355, 322, 300, and even back to episode 280. JT's going to put all the shows that I reference in the show notes so you can find it there. It's a very detailed process. It's not as simple as, I make $80,000, how much home can I buy? So let me get into the crucial parts of figuring out how much home you can actually afford. You're not looking to just get a number based on a little bit of information. A lot of people just think, let me run the numbers and see if I can do this. Here's the big thing that I see a lot of people do that I just wish they wouldn't, because they could get such a better result if they'd done it differently. It's not a yes or no discovery question. This is not a red light or a green light. It's not a go, no go. It's going to sound really basic, but I've seen more first-time homebuyers incorrectly dash their dreams by mistakenly thinking it's a red light or a green light. And they lose literally hundreds of thousands of dollars on this. Too many people do the research on their own, or they get an assessment from a lender. They get the number right in front of them. Oh, it's lower than they thought, or what they actually need. And then they stop. That's it. That's the end of it. Red light. And that's because no one's giving them the guidance of what to do next. So the only thing they do is they sit there and they just do what they think is logical. They just keep saving money. And of course, they've got no action steps, no plan, and no direction on what to do. Unfortunately, no support. Now, since this approval number that they get that gave them that bummed out moment, it's largely affected by the current interest rate. So quite often, it actually gets calculated with a wrong rate for them, an average rate, instead of the rate that they could actually get with someone who looked at their big picture. So right there, wrong information from the start. Boom, stop sign, and then no plan. So what do? Well, you just assume that you have to sit there and wait for prices or rates to drop so you can get to the number that you need. So when you're finding out how much you can afford, don't get a red light. It should be a starting line. This is not the go or no go. This is the first step in your plan. And what bums me out is I see too many people get to this point and they don't start a plan because they think, oh, that's not the right number, so that means I can't start my plan. No. Oh, that number's too low? All right, now I need to start a plan so I can help improve it. So to get the best interest rates for you, get your starting line and know that a lot of you out there might be a lot closer than you think, especially if you use an experienced first-time homebuyer realtor who refers you to the local lending team that can get you an interest rate that you didn't even think was imaginable. And I know it goes against the grain and what everyone else is doing, but that's what we're doing here in this revolution. We are making things better for tens of thousands of people out there because we know that doing it DIY, that means you're going to be calculating using incorrect data and you're going to get the wrong numbers, which is going to delay what eventually is going to be your big win. And that's not a theory. That is a fact supported by data. 72%. I'm going to say that again. 72% of the listeners over the last 6 years who are doing it DIY and reached out to me and said, hey, I think I'm 12 to 18 months away. When they finally did a deep dive in their numbers, thanks to a full unicorn team who found better options and better ways for them, far better than the minimum affordability they found on their own, 72% were under contract in an affordable situation for themselves in just 3.2 months. That is real results. So listen for the details in those episodes I mentioned earlier, and you can learn the unfair advantage that you can get over most buyers by starting months and months, even years earlier than most buyers do, working with a unicorn team to get your own personal roadmap and the steps. Yes, step-by-step instructions with free professional oversight. That is your game changer. That's what gets you the greatest interest rates. And working with the right team and getting the real factual numbers, it's only half the battle to beating high interest rates. Believing in your power to work with them and change your options, that's the other half. Now, your action step number 2, that's your credit score. And let's put the emphasis on the action in this action step. Start this right now, no matter where you are in your process. Not tomorrow, right now. It's because credit score improvements, they take time. You can find all the bells and whistles and tricks you want. Every single one of them takes time. The sooner you begin, the higher score you get, which ultimately means a better interest rate. Credit scores greatly affect what interest rates you can get, what loan programs you can get, and it even lowers the amount of fees that you have to pay. You know, I called it action step 2. This should be step 1. It's a no-brainer. Start working on this right now. Episode 304 has all the details. Action step number 3 on buying a home with a lower interest rate is exploring new builds. Now, I know a lot of you guys hate new builds, but some of you out there are like, yeah, that'd be awesome. I don't want to do squat to my house. Cool. Either way, take a look at it. Because especially right now in 2025, the builders, they're getting desperate to sell their inventory. I mean, they'd rather lower interest rates than lower the prices. So that means you can get a 2025 builder incentive. And we've heard them dropping rates to 3.99%. Be sure you listen to episode 279 for more information on that. And action step 4 to help make things affordable with high interest rates is start budgeting ASAP. Now, I know I just said the B word. Ooh, budgeting. Some of you guys are freaking out right now. I get it. I've got financial tips to make it less painful. There's a full 7-part series. I dropped all the way back in 2019. Starts at episode 19. How about that? Back in 2019. But here's the deal about budgeting. When it's done right, it's not sacrificing. It's not a restriction. It's power. You get to take control instead of drifting along, waiting for your paycheck to pop in. And the reason why we talk about budgeting for interest rates is because cash is king when it comes to getting the best rate. And of course, budgeting is going to help you with that. So you've got your budgeting and now you have a little extra cash. Here's how you use it to make those interest rates more affordable. One of the things I tell people all the time is to look into utilizing a lower down payment option so that you can have more cash when you're purchasing the home, and you can use some of that extra cash to help you work for a better interest rate. Here's how that's going to work. Say you already have a down payment of 5%, 10%, 15%, maybe even 20%. First, for those of you at the 5, 10, 15, you don't have to wait to save up to 20% because you're freaking out about the scary PMI payments. I know people have said that they're just absolutely the worst thing that could ever be, but they're like as frightening as a fluffy little kitten. And there's a whole bunch of math behind that. I lay that out in episodes 198 and 216. The deal is PMI, it is not a fool's choice. It is a privilege used by smart home buyers. So once you get past that hurdle and you figured out, okay, what happens when I put down less of a down payment? So you can opt to put down less, and then you could put the rest into something you create, a new home affordability savings account. And I know this goes against the grain a little bit, but people are starting to get the idea. Like I said, our revolution, it is out there. And I am seeing several younger financial gurus saying that you should always put as little down on a house as possible, because getting a loan that big, even at 6 or 7%, according to the big financial people, that money's still cheap. And leveraging this cheap money plus using the capital from your rent to subsidize it, that is a double no-brainer. Now, here's an example of how a low down payment option could work for you. All right, you got 15% to put down on a $400,000 home. That's $60,000. If you drop that to a 5% down payment, that's only $20K. And now you get to keep $40,000. Put that $40,000 into your new home affordability savings account. And you can access that account each month to offset the higher cost of a mortgage with a rate that you previously thought made the payment too high. Here's that math. All right, you get a loan at 6.5%. It's about $500 more than you wanted to pay. All right, well, if you drop that down payment, that means you got $40,000 in the bank. So right now, that $500 a month, it's something that you can pay with that money in the bank. But that's not everything we have to pay, because we reduced the down payment, which means you have a larger loan. Now you're going, oh my God, we just took 10% off of our down payment. That means our monthly payment's going to skyrocket. It's actually only about $250 a month. So right now you have $40,000 in the bank. It costs you $250 a month, and you were also concerned about the $500. So that's $750 extra dollars a month. That's the reason why you're not buying. It's just too expensive. Okay, you got $40,000 divided by $750. You have a cushion of affordability for 53 months, or almost 4.5 years. And every time I explain this to people, I make sure they understand it, that your mortgage payment's never going to be harder than the first 2, 3, 4 years that you have it. Because as you move forward in your life, rents go up, the wages go up, but your payment for your shelter stays fixed. Not to mention the fact that buying here in this high interest rate world means that you probably have an opportunity to refinance whenever that happens. And if you're sitting there over 20%, you don't want to get a loan under 20% because, ooh, no way, PMI. Oh my gosh, the math is so different. I mean, if you disagree, I'm imploring you, listen to episodes 198 and 216 because you have been lied to about PMI. There are lots of people making absolute never ever do this rules about PMI, but they haven't done the math. My answer to them is not a philosophy, it's arithmetic, and it's all there. There's a new formula to beat this housing affordability crisis. You can loan yourself, $20, $30, $50, $70,000 by reducing your down payment from 20% to 10% or 5% for only hundreds of dollars a month. And the PMI costs nothing. Right now, some of the PMIs we're seeing for an average $400,000 home are anywhere between $50 and $75. This is not just the current way to discover affordability. So if you don't know everything and you haven't explored the real numbers, just understand, I'm not offering a gamble, a way for you to jump into something that's risky. I'm offering the real mathematical solutions for how to do it in a new world. So do yourself a big favor, get educated, because that way you're not going to be left behind and trying to catch up in the next few years. And maybe for some of you right now, the lower down payment option doesn't really matter to you because you're below 3% in your savings account. Okay, add this to your goals. When you're figuring out how much you need for a down payment, your closing costs, add a little extra, and then you can use the extra funds to buy a better interest rate. Yes, I said buy a better interest rate. That's with something called mortgage interest rate buy downs. This tip takes a whole lot of personal math that you got to work with a unicorn team, but many well-informed buyers are using mortgage interest rate buy downs to get interest rates 1% less, 2%, or even 3% less than the current average rates. All the details are in episode 237. Or if you want to, in the 2025 market, instead of a buy down, you could get a free down. Let me explain how that works. Seller credits, they are on the rise in 2025. And you could use a seller credit to buy that buy down and lower your interest rate. For example, on a home listed at $500,000, if it's been sitting for a little while and you want to get the home at a discount, instead of offering $490,000, you can save hundreds on your monthly payment by offering $500,000, the full price, but with 10% back to you in a seller credit, and you can use that for a mortgage interest rate buy down that you didn't even have to buy. It's more of a free down. This is a great one to know because in 2025, seller credits, they're back on the rise. Now, here's a real life story about that. I was just texting this morning with a unicorn who's in Austin, Texas, who said that homes for sale in their area right now, they're sitting for over 30 days. And the ones he's got listed, they're getting lowball offers. So that is a market primed for getting seller credits. Yeah, he said it's such a shift that he showed a buyer 6 homes last weekend. And by the end of that day, every single listing agent had called him and asked him, what's it going to take to get a deal? He just showed the home and everybody called him back. That is unheard of in the starter home market for the last 5 or 10 years. I mean, usually there are 10 people bidding on the home in just a couple open houses, and you call, you text, you email to try to talk to the listing agent, and nobody follows up with you. But the fact that he showed a buyer 6 homes and all 6 agents were following up trying to make a deal, that is the pathway to affordability for buyers out there. I mean, you know how I said on a $500,000 home, offer $490 and get $10K back? Sounds like where he is in Austin, you could offer $485 with $10,000 back. Then you get a mortgage interest rate buy down and get the home for a $25,000 discount on what it's been selling for in recent times. Now, the last couple action steps to help you buy your first home with these higher interest rates, well, to some people out there, these are going to be highly controversial. Ooh, old man on a mic getting edgy. This is a carefully created strategy used by hundreds of regular people with normal paychecks and regular old normal jobs, and the math checks out. But here comes this controversial technique. Let's explore the math behind using your retirement to fund your home purchase. Okay, I can feel several of your butt cheeks clenching right now. Now, let me undeniably assure you, I am not trying to sell you a course on how to beat the sheep and get rich with some sketchy scheme. These tactics are not get rich quick. In fact, nothing here at How to Buy a Home is. All the education, the programs, the methods, the tactics that you get here are stable solutions with math behind them. How to Buy a Home is not looking to outsmart the stock market and so that everybody can retire by 40 years old. By sensibly using your retirement savings or altering your retirement savings plan a little bit, that's not a subtraction from your future security. It's an addition to your current plan in the form of diversification. You're not taking away from your future, you're securing it by diversifying your retirement portfolio. And that tip, diversification, that's one of the main tenets taught by all the people out there with the safe and conservative financial advice. So when I bring up the idea of altering your contributions to your retirement funding so that you can buy a home and afford the new higher interest rate, remember, the platform right here that is giving you that advice, it's 100% built to empower home buyers to work the right plan on their timeline with no pressure, no gimmicks, and no wild promises of riches. Just guidance and advice. Safe and secure is the mission. Now, the full details on how to do this with a 401k, they're explained way back in episodes 22, 58, 75. And the cool thing is there are a few interviews that with real people, smart, financially savvy people who heard this mathematical strategy, and they use their retirement funds to fund their own home purchase because they figured out that they were just going to diversify their long-term savings plans and add another form of stability. Those are in episodes 113, 135, 161, 163. I think there's some in the future, but those are the only ones that I've got written down right now. I know the traditional financial gurus warn you this isn't safe, even fiscally irresponsible. Well, that is old thinking. It's the most linear path to home ownership if you follow their plan. And in fact, in the current housing market, if you follow that plan, you're going to be a renter till you're 50 years old. And I respect the fact that you're heeding safe, older advice. You're adulting now, so you're dedicated to being responsible. So I'm not challenging you. I'm challenging the absolute rule. The people who subscribe to that rule and preach that rule, they haven't factored in the new big capital that you spend each month on your rent. I mean, you're already paying, so why not build wealth while you do it? Look, let's flip the script. You're already handing over your biggest chunk of cash each month, your rent, and what do you get? You get a roof over your head and zero return. Now imagine that the same monthly payment could be working for you. When you buy a home, you're not just getting a place to live, you're investing. Real estate has historically grown around 4.5% a year. So that's not just a roof, it's a long-term asset, a wealth-building machine that just keeps on building while you sleep underneath it. Or in it, I guess that would be the way that you do it. It's just like your 401k. You put money in, that's your down payment. And then you keep adding to it. That's your mortgage payments. But here's the kicker. The investment uses money you were already spending anyway. It's not extra. It's not on top. Your rent that you've got right now, that's a donation to your landlord's retirement. With a home, you're going to be contributing to your own, to your future. It's a powerful diversification, stocks and real estate. No more eggs in one basket. And think about this. You are converting wasted rent into something, equity, wealth, stability. It's the same math that your retirement planner uses, only this time it's tied to your daily life. So it's not just an abstract extra thing that you pay each month that shows up on a quarterly report that you can look at and go, that'll be nice someday. No, this is part of every single day and you're using it. And when it comes to the higher interest rates of today's market, I have to be cautious when I say this to everybody, but when you have the real long-term thinking, since we're in retirement mode right now, keep this in mind. You're not buying the interest rate. You're buying the time in the market. A lot of people aren't jumping in right now because the rates are too high. Well, you're buying the more longer, bigger time period that you own the home. And that is going to buy you freedom, that you can't even comprehend. Of course, you start with freedom from no more rent hikes, but this is going to be even bigger than that. So I'm not telling everybody go out and do this, risky move to help them fulfill their vanity move they want to make, by becoming a homeowner. This is a strategic pivot. Your money that you've already got flowing out, why not redirect it towards your future? Let's say right now you rent for $3,500 a month and you compare that to a mortgage. We'll look at 6.5% because I know the average is 6.67, but you've done some good planning and you can beat that average. Well, at 6.5%, a payment on something similar is going to be $4,200 a month. And you believe that's just too much of a stretch financially because you right now contribute $1,000 a month to your 401k and you will not reduce that commitment to your retirement because that's responsible and important. I get it. You want to play safe. And you've decided you're only going to buy a home when you can afford the full new mortgage payment and continue to fully fund your retirement. Okay, well, let's say that $500 of the $1,000 that you contribute, let's say that's matched by your employer. Cool. I'm not challenging that at all. In my opinion, that's non-negotiable. You keep putting that away in your 401k and get that match. So I'm with you on that. Now we've got $500 left that we could diversify into another investment besides that 401k. It's just reallocating the funds somewhere else. So right now you pay $3,500 in your housing expense. So if we reallocate the $500 there, that takes it to $4,000 a month. You've got that money. And the new mortgage payment is only $4,200. All you're doing is diversifying the non-negotiable $1,000 monthly commitment, that contribution you are absolutely going to do, into two entities, the 401k and your home. You are not taking money away from your total retirement. Here's a little wordplay game about it. You're not mortgaging your future by taking on a home mortgage. And then here's the second way that you can use your retirement to beat today's high interest rates. It's to borrow against your 401k or your IRA to pay for part of or all of your down payment and closing costs. A withdrawal from one vehicle, one retirement program that you have set up to fund another. And that other vehicle that you're funding is even more mathematically lucrative than lots of 401ks and IRAs because it's going to immediately begin utilizing your largest monthly output by transferring that payout into an asset that grows, just like your retirement funding does. Now, I know, first I talked about, reducing your contribution. Now I'm talking about borrowing against your retirement. I know it sounds crazy and irresponsible, but it's not. I've seen thousands of first-time homebuyers use a chunk of their current retirement funds to purchase a home. People have done this even when interest rates were low. But in 2025, you can use this to offset the cost of a mortgage interest rate buy down, or you can just keep the rate as it is if the math works out for you, so you can set up your own affordability, a savings account, as I discussed earlier when I was talking about the lower down payment options, pulling from that every single month to make the new payment something that you can work with. Now, here are some of the options for withdrawing from your retirement program to diversify your portfolio. Many 401k plans allow you to borrow up to $50,000 or 50% of your vested account balance, whichever one is less. And here's the kicker, with no taxes and no penalties. That's the big advantage to this one. So you can pull those funds out. And I've seen this work for, again, 2 decades. Also, if you've got different type of retirement accounts, this also can work for 403Bs, 457Bs, TSPs, your thrift savings plans. The rules are similar to the 401ks, but it's more along the lines of what they call a hardship withdrawal. So make sure you check with your money manager about that. And you can also do this with IRAs, traditional and Roth. There's a penalty-free withdrawal up to $10,000 for a first-time home buyer. This is real. And first-time home buyers who look at the math, they get into this, and thousands upon thousands of them do it every single year. So just check with your plan administrator to get the details of which of these can work for you with these first-time home buyer benefits. With the new high cost of renting, there's big math that all the old-timers seem to miss, and it is not recklessly sacrificing your future. Using a one-time withdrawal from a retirement account into a home purchase, in many instances, can actually gain you more in your retirement savings when you do all the math. Let me say it one more time with feeling. It's diversifying your portfolio, and it utilizes a huge capital monthly output that you are not currently using for yourself. It's active, not passively waiting for interest rates to drop so that you can get more affordability. And it's also paying for a life necessity that you already pay for anyway. It's money used and saved simultaneously. All right, homies, pat yourself on the back now. Be proud of yourself for listening to this real estate nerd for an hour. There's no easy tip to get you some magical lower rate. It takes insider knowledge on how the game is working right now. I'm not here to blow sunshine and offer fantasy schemes that overpromise and ultimately are going to wreck you financially. These are research-tested and proven techniques to help the average person gain above average advantages. The revolution that we got going here is for the every person, the little guy, but it also is for the people that feel like the ship of home ownership has sailed past them. It's not. Things are here and available for you, and they're working, and together we are hammering the establishment with wins for buyers. So thanks for being here, and if it helped, if you're getting any value out of me dropping all this stuff in your ear holes for free, then please, please, please just take a minute for me and write a review on Apple or Spotify. It does so much to help get the podcast to more people. Or you can just text it, share it to a friend right now. Let the other renters out there know there is hope. And of course, as always, you can check us out on Instagram and YouTube, How to Buy a Home. And howtobuyahome.com, that's your place for all your questions. No inquiry is too small, and ignorance, that's not an impairment or looked down on at How to Buy a Home. We're here to give everybody an opportunity to get themselves a plan. And remember, every market has a challenge, and every challenge has solutions. You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyahome.com to get started.